So there's one concept in trading that sounds complicated, but once you understand it, it actually becomes surprisingly simple. It's called order blocks, and most people either overcomplicate it or use it completely wrong. The next few minutes, I'll break down what order blocks actually are, how to identify a valid one, and the biggest mistakes beginners make. So what is an order block? Let's keep this simple. An order block is basically the last opposing candle before a strong move. Now on paper that sounds almost too simple, because what it's really showing you is where the big moves actually started. So for example, before a strong move up, you'll see a final bearish candle. Before a strong move down, you'll see a final bullish candle. And that candle is important because it represents a point where large buyers, banks, institutions, smart money, stepped in and moved the markets. So when price eventually comes back to that same area, there's a good chance they'll defend that area or they're looking to add more. And that's really the key idea here. Instead of chasing price after it already moved, you're waiting for price to come back to where the move started, because that's where the real interest was in the first place. Now the next question is, how do you actually spot a good order block on the charts? So let's go through some checklists to filter out for high probability ones. When I see a potential order block in the charts, the first thing I look for is there a strong move away from the order block? Because this is kind of the whole point. If that candle really represents institutional activity, you want to see it leave aggressively with strong candles, and when price moves like that, it usually leaves imbalance or what people call fair value gaps. So now you're not just looking at a strong move, you're looking at a strong move that was also inefficient. And when those two things show up together, it's a good sign that there was real participation behind that move that would often lead to the next leg up or down depending on where the market is headed. The second thing I look for is break of structure. What really takes an order block from good to great is whether that move actually takes out previous high or low. Because if that's the case, then this candle isn't just some random candle anymore. It becomes significant to the overall market structure. In an uptrend, for example, the market forms higher highs and higher lows. And those highs don't just break by accident. They break because there was enough strength to push price beyond that level. So if that break of structure originated from your order block, that tells you this is where the move that created the new high actually began. In other words, this isn't just a level, it's the origin points of a new swing in the markets. And that's why order blocks that cause break of structure tend to be higher probability, because they're directly tied to how the market is building its structure, not just reacting temporarily. By the way, if you're finding this helpful so far, feel free to drop a like and subscribe. It really helps the channel. Now, for this third point, let's get into one of the most common mistakes beginners make when trading order blocks. And that's not being aware of liquidity sweeps. A lot of beginners will see an order block, place their buy or sell limit orders there, and place their stop losses just very tightly above or below the level. And sometimes that works, but a lot of the time, price will actually go slightly beyond or below the order block first, take out those stop losses, and only then move in the intended direction. What's happening here is liquidity sweep. The market is essentially grabbing stop losses and resting orders to create enough liquidity for larger players to enter their position. Because they can't just enter all at once. They need someone on the other side of their trades. So you'll often notice this in the form of candles with long wicks, either at the top or at the bottom depending on the context. So instead of seeing that move as the setup failing, it's often just the market clearing liquidity before the real move happens. And when that sweep happens right before price moves away from your order block, it adds another layer of confirmation. Because now you're not just seeing movements, you're seeing intent behind the move. And finally, I look for the first time price comes back to the level, because that first retest is usually the strongest. This is where both institutional and retail traders are likely placing their orders, whether that's limit entries or unfilled positions from the initial move. But the key idea is this: those orders don't last forever. The more times price taps that area, the more those orders get filled. And over time, there's simply less interest left at that level, which is why it starts to weaken. So ideally, you want that first clean return, because that's where the highest probability usually is. So order blocks are useful concepts, but not all of them are created equal. When you combine them with structure, momentum, and liquidity, they become a much more reliable way to understand price. And this is something that gets clearer the more you see it on the charts. So if you're interested in more trading concepts like this, feel free to follow the channel so you don't miss the next ones. I will see you in the next video.